Thank you everyone who has joined. So I, what we will do is, okay. So one, Google Meets only allows to like 1 hour of video. So I will send out an extension if we cross that 1 hour, or this thing stops in between. Okay, I'm going to just send that now. Okay, uh, so that if it does stop, then we can continue on the other link. You just briefly, just to cover what we did last time, and then we'll continue from there. I've already, you know, shared the video of the last session as well. So what we covered last time was essentially, just quick recap. We talked about goals in terms of our financial goals. We talked about the benefit of starting early, power of compounding. We discussed on a framework of investment choices, the safety liquidity SLRT framework. We discussed briefly difference between investing and trading, and what's the real inflation. Yeah. So what we'll do now is, we'll start with uh, what is now goal-based investing. What do we mean by goal-based investing? Okay. So why do goal-based investing? Is basically so that we are focused on the target and not the path. So where we want to reach and not how we reach. Right. It also, because in the sense that if I have a goal of a certain amount at certain time, then that's what I need to reach, and not focused on whether this month I got 10% or 15%. So it's more towards the target. It also helps us to look at the portfolio. So when people talk about we should do a review of a portfolio every 6 months, 12 months, what is it that you review, right? Generally, otherwise, in absence of goal, what we review is how well my fund is doing. Is my fund the best performing fund, or the near best performing fund, or my stock is the best performing stock or not? And if it is not, then we will go around and try to change it something, right? Rather than looking at whether I'm on target to achieve my goal. Right. Similarly, it helps us set risk parameters for the goals, right? So some goals, as we discussed last time, are non-negotiables, right, which have to be met, right? And some goals are negotiable. So basis that we can have different risk parameters for goal, right? So if my goal is to save for my child's education, then again, depending on how much time is left for the goal and how much, uh, you know basis that I will decide on the risk of what risk I can take on what I'm investing, how I'm investing for that. It also helps us manage fear and greed. Okay. Now this is important because, as you start investing and as you start seeing your portfolio grow, there is this tendency that we have to to kind of bank what we have, the what we have already got, right? Profit booking, right? So bank the profit, and so that you can, so that we don't lose this much, at least. So that comes from our a bias towards risk aversion, right? So we are all essentially risk averse, right? So we want to bank what is already there, so that at least this much is not lost. This is already I've gained, so let us do the profit booking. Now, the moment we do profit booking, essentially we break the compounding, right? And similarly, we we are fearful when the market drops something. Then we said, no, boss, let me not lose more, and let me get out of the market now before I lose everything. Okay. Now, how goal helps in that is because if your goal is still far away, right? Your goal is still 5, 10 years away. Then what is happening today in the market is really inconsequential to you. Okay. it will, yes, the market will keep going up and down. The value of the investment will move up and down. But as long as you are on the right path towards your goal, you should stick with it. And doing investing basis goal helps you manage that little bit better. And similarly, to measure success, so whether my investments are successful is basically equal to whether that those investments are letting me get to my goal. Okay, that's all the measure of success is. The measure of success is not that I got a 20% return or a 5% return or something like that. The measure is simply whether it is allowing me to get to my goal. Okay, so how do we do goal setting? Now, all of us in our um, professional lives, right, do these goal settings. I mean, we are asked to do goal settings every year, and then end of year we are managed again. Our performance is reviewed against those goals. It's not a very different concept. Same concept, goals. I mean, right. Now, typically, how do we define goals? We say, I want to retire by 50 or in the next 5 years. Okay. Or I say, I want to save for my children's college. They are currently 4 and 6 years old. Okay. Or we say, I want to buy a car of 20 lakhs in 3 years' time. Now, are these good goal definitions? Anybody? Want- Hello. I'm audible, right? Hello.
Yes, sir.
Yeah. Okay. I just thought I was speaking to myself. Okay. So, are these good goal definitions? Right? Do they sound like good goals?
Yes.
Huh?
Yes.
Or do you see any challenge with this? So, if I have a goal like this, what do you think is the challenge here? What is missing?
Net
Uh,
Huh?
It
net
doesn't seem
worth
to be
or the
realistic.
wealth.
Sorry, two people at the same time. One by one? Hello?
It doesn't seem to be realistic.
I mean, it depends, right? I mean, it doesn't tell you. Okay, realistic is one part, but how do you know it is not realistic?
It
because
doesn't specify the amount that how much would
Yes.
you like to
So it
retire
doesn't.
with? What is the
Correct.
purpose that you'll have?
Correct. So it doesn't tell you the amount. It's not right. It doesn't tell you the amount. How much you need. Okay. Clearly,
Right.
right? And
Uh,
it doesn't tell. It doesn't talk about amount. Right. How much do I need? Right. Again, and so it does say in 5 years, but right. Again here, 20 years. Right. So if you look at, I mean, we know this. We do it in our offices, right, and in our workspace when we are asked to put goals. We need to be specific. We need to be measurable. So, what is the exact amount that is needed? Is it achievable? Right? That somebody asked. Somebody said it doesn't look achievable. Right? So, is it really attainable? Is it realistic? Okay. So, is the goal that is that I'm setting is a realistic goal? And what is the time that I need to achieve this goal? Right? So that is how, if we go with that approach, I mean, this is the same approach we are asked to set our goals when we put our annual goals, right? So the goal is to buy a new car, right? Now, to specifically, I want to save for the car's down payment. How much? I want to save 3 lakhs for the down payment, right? So I will, if I save 10,000 per month from my salary, I should be able to get that. Okay. Realistic is because I can save 10,000 given what my current spendings are. So if I save 10,000 for next 2.5 years, right, then I should be able to get to 3 lakhs for my goal of buying a new car, or at least having a down payment for that car. So that is kind of a, so then it becomes I plan to save 3 lakhs by saving 10,000 per month over the next 2.5 years, gives you now a more realistic goal. Okay. or what we call as the smart goal. Hmm? Now, very quickly in terms of, so how do I know how much I need? Okay, so that is another question that comes. Some are easy because okay, I know a car. This car value is 5 lakhs, 10 lakhs, 15 lakhs, 20 lakhs, whatever. But some goals are I don't know. Okay, so I don't know how much I need for if I have to retire. I don't know how much I need for my child's education. I don't know some of the things I don't know. Right. So how can we maybe do a quick or goal calculations? Okay. So one is a simple mathematics, right? So if you know your current value of the goal, you know how much time it is needed to get to a goal. You have left for the goal, right? What is the inflation for that goal specific? So then you can calculate the future value, okay? And then once you have the future value, you can then find out how much you need to spend how much you need to invest every month, depending on where we are investing. Yeah. So if you see, this is the formula, right? I mean, this is the same formula we all learned, I don't know, in grades 5 or 6, which is the interest formula, right? So the future value of the goal is equal to current value to 1 plus inflation by the time, right? So if my goal is to buy, let's say, a car which is currently costing 10 lakh rupees, I know the car prices go up, let us say, by 7% every year, and I need to do it in 5 years, then I can calculate how much possibly the car will be valued 5 years from now. Okay. Similarly for education, etc. So the education maybe the inflation is 10% or 15%, right? Like that. So each goal will have a different inflation, and depending on that inflation, we need to see how much is the future value. And once we have calculated this future value, right? Or you could use a tool as well. I mean, there are tools available online. I mean, I've shared a bunch of tools in a Google folder, right? So that also you could use, or you could use any tool that is available, but at least will give you some value to target. Okay. Now let's see a quick example. Suppose you need 25 lakhs in present value for your kids' higher education after 10 years. Okay. So amount required is 25 lakhs. Time to goal is 10 years. Amount already you have is 5 lakhs. So what is remaining, right? So what is required then is 25 minus 5, okay, in 10 years. Okay. So it's about 2 lakhs per annum is what you need to save. Now there is an assumption here that this money that you're going to put, right, every year will, including this amount, will at least grow by whatever is the higher education inflation is. Okay, so if that assumption is true, then all you need to do is to do simple calculation like this, and then you say, okay, I will if I save 16,677 every month, in 10 years time I will have the future value of 25 lakhs done. Okay, does it make sense? Clear?
Yeah, yes, sir.
Yeah. Okay. Or similarly, you can do the retirement corpus. Okay, so current value of expenses that I have is 12 lakhs per annum. I have 25 years to retire. Right? Years in retirement, I'll have 25, so maybe I'm retiring at 60, and then I'm expecting to live till 85, so that is 25 years, right? So then 25 into 12 lakhs is 3 crores. Hmm? Okay. Now I already have say 25 lakhs, so the gap is 2.75 lakh, 2.75 crores. I have 20 years to retire. So annual that I need is 2.75 by 20 is 13.75 lakhs, and 1 point, again, this is my monthly required. Again, the assumption is that this money and this money together can grow at least equal to or higher than the expected inflation of the talent. Okay, so if my expected inflation of retirement is 7%, okay, then I need to put something somewhere where I get more than 7%. Okay, simple as that. Okay, if I'm putting this amount, of course, if you're putting more amount, then you can even live with less than 7%. So if you are, if you say, was I am only going to put in only in FD trust, then this amount will have to be much higher, and you can then go with less than 7%. Okay, or if you are, so that's how kind of, these are simple calculations to do. Okay, so again, another calculation to say, okay, can I retire now? Okay, do I have enough to retire now? Okay, same calculation. So if you have 1 lakh today, so your expenses are 1 lakh, so you need 12 lakhs per annum. So multiply that number by 50. Okay, so whatever is your current expenses, okay, if you multiply that by 50, that much amount, okay, that much dollar or rupees if you have, okay, then you could say, okay, I can retire pretty much. Okay, now the amount that you need to retire, or that we need to retire, okay, grows every year. Okay, so if it is today is 6 crores enough for me to retire, next year I would actually need more, not less. I know it sounds counterintuitive, because if I retire after 1 year, then I should be needing less, because I have now less years in retirement in that sense, right? But by that time, my expenses would grow, and therefore the calculation would go back and give you a higher amount of what you need to retire. Okay, any questions on this one? The number 50,
No, sir.
clear? Okay, very good.
Sir, why number 50 we are assuming? Why we are interpreting?
Okay, see what
Number
happened.
of,
Yeah, so um, so basically, see, if you heard of, you must have all heard of this 4% withdrawal rate formula, right? So saying that, we can actually withdraw, if we withdraw 4% every year, then we should be able to, I will never kind of run out of money, and that is sustainable. Now, what I think is reality, especially if you are in India, is, again, depending on where you invest the retirement corpus, right? Now, assuming your bulk of your retirement corpus, right, is invested in fixed income, in fixed income, instrument, whether it is FD or bond or something, right, and a mix of fixed plus, let us say, equity or mutual fund, right. Now, essentially, at a portfolio level, your return that you could expect, right, is, say, somewhere between 8 to 10%. Okay, that's the return that you can actually expect on your retirement portfolio, given a mix of fixed income and equity. Okay, let me just see if I can do a whiteboard. Okay, so say, let's say you have in retirement, you have 50% in fixed income and 50% in in equity. Okay, and this is your fixed income. Okay. Now fixed income will, let us say, give you 6% return. Okay, and this one gives you 12% return. Okay. Okay. So at 50%, this is 3%, and this is 6%. Okay. So net is 9%. You get that? Your inflation, okay, if your inflation is around 7%, then the net you receive is only 2%. Okay. So that is all actually you can withdraw safely. That is the calculation. So 1 by 2% is equal to 50. Huh? So that's where the 50
Okay,
comes
okay,
from.
sir.
That's where the 50 comes from.
Okay, sir. Understand. Thank you, sir.
Now, of course, you can change it, but I mean, as we did the other session on retirement, you know that you know, so one could argue why not have more in um, more in equity, right? If I can increase this, right? So if I make this 80% and this 20%, then I can make this as whatever 1.2, and this will become 9.6. Okay, so it'll become 10.8. I mean, you can see it is not going to make a huge difference. Yeah? So something like this, and then maybe I can go for a 3%, 4%. But we know, we did that session the last time, which clearly
Yes.
tells you that I think the sweet spot of fixed and equity is somewhere between 40 to 60 to 40 60 to 60 40. Okay, anything beyond that is a problem. Okay, too much volatility otherwise from equity, or too less return if you put more in fixed. So obviously, you can see if you put 100% in fixed amount, right? So then your net return is 6%. Okay, inflation is 7%, and then you need basically minus 11%. So you can imagine now how much more money is required. Okay,
Okay, sir.
that's the problem. That's the issue. Okay, so now we'll just cover the process of investing. Okay, this um, so we okay. So one is, we let's follow a 50-30-20 rule. Okay, so 50% of your income should goes into necessities, which is your rent, food, transport, education for your children, work, school fees, etc. 30% around luxuries, new car, new mobile, holiday, eating out, entertainment, all of that, and 20% at least minimum you should save for your future goals. Okay, so 50-30-20. So 20% at least of your net income every year, every month, is what we should be targeting to save. Um, okay, the more you do, the better it is, obviously, from that perspective. Now, just simple tips. So obviously, keep your fixed cost low, right? So, for example, home loan, home EMI, right, is a fixed cost. Okay, keep it low. I mean, keep your fixed cost lows so that in case when there is a downturn or something, you have room to, you can go from there. Don't fall into a debt trap. Okay, so debt trap is where when your most of your income or a big percentage of income is going towards servicing your loans. It could be a home loan, it could be a car loan, it could be a personal loan, any other loan, or a credit card or something. If a huge percentage of your income is going towards servicing those, then you are in a debt trap, okay, or about to get into a debt trap. Okay, the total loan should not exceed 40% of your net income. Okay, so if your net income is 1 lakh a month, then not more than 40,000, okay, should be going towards your loan. And typically 30% of your net income, not more than 30% of net income towards home for a 15-year home loan. See, I see a lot of people now, we take 20-year loan and 25-year loan simply because 15-year loan I cannot afford. Or at the house that I want, that 15-year loan, I will not be able to afford it. And that's why we go for 20 and 25. Now, I mean, in my mind, 15 years is also too long. Okay. But 2025 is which apartment. So what I would say is if you're looking to buy an apartment, just go around, look for a building that is 20 or 25-year old. Okay, because that is what is going to happen for a loan that you take for 25, 20 years. Only after that time period is when that house or that apartment is going to belong to us or to you, right? Now, would you buy a house which is 25-year old? Okay, so and obviously the longer is your tenure for loan, more we end up paying in interest. Okay, so that is another reason why we should try and take it as low as possible and ideally not more than 15 years. Similarly for car, right? Should not be a car EMI should not be more than 20% of your net income, and the loan should not be more than for 4 years. Again, the reasoning here is a life of a car in India, let us say, is about 7 years. Okay? So 4 years you pay loan, and 3 years at least you can run it free of loan. Okay, so that is when you basically own the car now, and now you can run it only at the cost of servicing and the cost of fuel. Okay, never mix insurance and investment. Okay, so these are two different things. Term insurance is what we go for, right? Not insurance that gives you returns. Okay, and even in term insurance, take insurance only till the time you intend to work. Nowadays, companies are selling insurances, term insurances till 80 years, 85 years, 90 years, and selling it as inheritance. Sir, even if something happens to you 90 ke baad, that money will be now inheritance to your children and stuff like that. That's not the objective of insurance. Okay, so insurance, if you intend to work till 60, take insurance till age of 60. After that, there's no need for having insurance. Okay, life insurance. So insurance is there to cover for loss in income. Okay, because if I am the bread earner, if something happens to me, for that I need to have an insurance so that my family is taken care of. Avoid ULIP. I think we can have a separate session on this, but ULIPs are again sold by banks nowadays as mutual funds, and these are not mutual funds. Okay, they are no longer nowhere near mutual funds. In any case, for some time they had a tax advantage, which I think is no longer there to that extent, right? And we should simply be avoiding this. You guys still there, right? Hello, hello.
Yeah, sir.
We can. I'm just trying to check you're still guys are there because I'm not seeing the screen. Okay, because it's now like more than 1 hour, so that's why. Okay. Equities give the best long term returns. Okay, from a long term return perspective, nothing beats equity. But choose the investment as based on your goal. So remember this SLRT framework that we discussed last in the last session. So these are your simple tips for financial success, right? So keep your fixed cost low. Don't fall into debt trap. Keep your loans less than 40% of your income. Don't mix insurance and investment. Stay away from ULIPs. Equity are the best long-term return, but that doesn't mean you only invest in equity. You choose the investment vehicle as per the goal that you are after. Okay, in time to the goal, etc. Okay, so the simple plan is first thing that you need to have is to have a health and life cover. Okay, that's the first thing you need to have. If you don't have one, take one. Next one, we need to have a contingency fund or emergency fund. Okay, this should be in this is should be somewhere which is near cash. Okay, so it could be a bank FD, for example. Okay, or could be liquid fund, but a bank FD or something that you can break when I need to break and get the money. Okay, so there try and keep 6 to 12 months of expenses in a contingency fund, somewhere where I can access that cash on demand. Have clearly defined goals, right? Have a proper asset allocation, then make a plan and then stick with that plan. Okay, so see that is this part of it is the most difficult part. Okay, because we are all kind of tuned to action. Okay, we want to do something. So if let's say I start an SIP in 3 or 4 funds, once it runs for 6 months and 12 months, I want to now find out is those the right funds to invest? Should I be changing my funds? Right? Something I want to do, because if I don't do something, then I feel I'm not doing anything. Right? And it's very hard then to keep to that plan, because we have this propensity to do something, okay, to run. Even if I'm running on a treadmill, I should run so that at least I get the feeling that I'm doing something. Okay, so when we do, so as I said earlier, when you review your if you review your investment, review it with the lens of the goal that is set. Okay, not with the lens of whether this fund right now, if you are, let's say, investing in a fund, that is this fund doing well. Okay, because no fund will always do well. Some fund will do better, some will do later, but I mean, at some stage, yes, maybe the fund choices have to be reviewed, but not like every 6 12 months. Okay, and try and automate your investment process. So this is the other thing. So the biggest challenge I see, having dealing with people uh, differently, is that that there is this simple lethargy, or not just not starting. Okay, and not able to then keep up with the plan that has been made. Okay, so so the people who take a long time, so this is one thing that we keep putting off. Okay, is the investment. So I'm saying, try and automate that process. Sign up for investment account. Have a If possible, have a different bank account for your investments. Every month nowadays, every bank has a standing instruction. Something is there, right? Transfer your money from your salary account, let's say, or your income account, every month, whenever it is there, to this investment account. So remember we said, right? So your income minus investment is equal to your expenses. Okay. Okay. So take out your investment first. Okay. And then from that investment, you have your SIPs. Okay. And whatever is left, now it is there for you to spend. And that spending includes your EMIs. Okay. So EMI is also an expenditure. Okay. We'll just quickly, last, we'll close this and then we'll continue in the next. Any questions before we get there, or maybe we'll close at this stage? Hello? Hello? You guys there?
Yes, sir. We are here.
Okay. So, any questions? Because I think we are pretty much excess of time. Hello? Hello?
Hello, yes, Raju.
Anybody has any questions, and we'll cover the rest in. I'll set up another session. This session, any questions? Any comments before we close? Okay. If nothing, then thank you. We will will set up another session and we'll continue. We'll do in one next week. Yeah. Okay.
Yeah, sure.
As well.
Thank you.
Thank you.